This is BankCents, the podcast that makes sense of all things banking. If there's something you don't understand about banking or finances, you're not alone. Our industry experts are bringing you informative and enjoyable conversations to break down bank jargon and dive into hot-button financial topics. And now, BOS, a community bank located across Illinois and Missouri, presents BankCents. Here's your host, Gregory Marantz.
Welcome back to the BankCents podcast, the podcast that makes sense of all things banking. I'm your host, Greg Marantz, Senior Vice President here at the Bank of Springfield. And on today's podcast, we're going to be diving into financial literacy. In this episode, we're going to be breaking down savings accounts, CDs, and also minor accounts. I'm excited to be joined by our guests and also the person that does our intro and outro to the podcast, Tim Welch, Vice President and Branch Manager at our Chatham, Illinois location. Tim, how are you doing?
Doing pretty good.
Welcome today. We're excited to have you on.
Yeah, thanks for having me. That's
to
great.
Talk about savings and CDs. Tell us a little bit about yourself and what you do at the bank before we really dive into the meat of the podcast.
Sure. Well, I've been with the bank 11 years, and like you said, I run the branch out in Chatham, but I try to do even more than that. So, of course, we're really involved with the community. I'm a Chatham Chamber Ambassador currently, involved with the Chamber. I've worked with the Capital Area Realtors in the past, the Rotary, all those types of good things. But my family and I live in Chatham, and I've been at that branch for 8.5 years, and I really enjoy it. And I'm able to use a little bit of my background in broadcasting like we did with the intro for the podcast. But I enjoy doing that. But one of the other things I do is help with some of our new hires. And we have a class that we teach with them on customer service. And I've been a part of doing that for 10 years probably. So there's a lot of fun stuff to do around the bank.
Yeah, and I know one of the things you do is you get out in the community and, teach some of these financial literacy classes. And that leads us right into our topic today. And we're talking about, savings accounts and CDs and how to get started. So let's first step into savings accounts.
Sure.
When you're at any age in life, it's one of the first ways to start saving and planning for your future. So tell us a little bit about savings accounts and what you can do to really start planning for the future.
Well, yeah, savings accounts are something that I think everybody's familiar with the term, and they're relatively simple. They are interest bearing. So while the money's in there, that you may earn a little bit of interest from a savings account, which everybody likes to see that. But it also gives you a chance to put money to the side. It's not supposed to operate like a checking account. It's not really made to do transactions off of. You don't, to go in and withdraw funds and deposit funds frequently. That's not really what a savings account's for. It's to deposit funds. They're there if you need them. They're liquid, so you can grab the money if you need it. But it's there to set aside for those emergencies, for those things that you don't want to go into debt because you got a flat tire. You want to have some money set aside for those types of things. So that's really more what a savings account is versus a checking account.
Yeah, I think that's one of the buzzwords you hear a lot of times nowadays is that emergency fund, to make sure you have that in case something pops up that you weren't planning on.
Yeah, 1 in 4 people in the U.S. don't have an emergency fund of any kind.
No.
So, even to have some money in savings, especially right now, is really advantageous. 57% of Americans have less than $1,000 in savings. So, there's all these rules of thumbs about how much you should have saved. They talk about 3 months worth of expenses. 6 months worth of expenses would be ideal. But if you've got less than $1,000 in a savings account, that's probably not going to get you through 1 month of expenses. So it's really important.
Yeah, and I think that's one thing that we really want to impress upon our listeners too is it doesn't matter how much you start saving, but just start saving. If you're putting away $10 or $20 per paycheck.
Absolutely.
I think once you get the ball rolling on that and get it snowballing down, it starts to build, and the interest obviously helps that grow as well.
Absolutely. And one of the things that you can do through online services is every week or every 2 weeks, whenever you get paid, have money that automatically goes into a savings account. It gets deducted. Sometimes you can get it sent directly from your check, but even after it's deposited, you could have it moved the same day, so you don't even miss it. That money goes into savings, and it's there if you need it, but it's not something you miss. After that first week of, I put $50 in savings this week, you won't miss that $50 after the first week because you'll adjust your lifestyle to affect it. It's really important.
Yeah.
So.
Now, are there any, compared to checking accounts, are there any limitations that a savings account might have compared to those checking accounts that, if you're opening a savings account, you should be aware of?
Yeah, we do limit the withdrawals. You're supposed to get up to 6 withdrawals in a month. Is really the max. And a lot of institutions will give you the first 3 for free, but 4, 5, and 6 may have a charge to it. So that's something you want to be aware of and keep an eye on. So if you're at your 4th or 5th, you might get a charge at the end of the month that you weren't aware of.
Now, so you have your emergency fund set up. Now, are there other investment vehicles, and this kind of leads us into our next topic, that you might be able to put some of your money into and get a little bit of higher interest rate out of?
Sure. CDs. I mean, that's something a term we throw around all the time, but CD means certificate of deposit. So it is essentially a savings account that you are going to earn interest in. But what happens is you sign a contract when you open the CD that allows the bank to hang on to those funds for a certain period of time. It could be 6 months, a year, 2 years, up to 5 years. And that means that you can't touch that money until that time is up. And then in exchange for that, the bank will pay you a higher interest rate than they would on a savings account, for example. Now, you can access the funds if you're in an emergency, but there's going to be some fees associated with that. So it's really got to be money that you don't want to touch for that period of time, whether it's 6 months or a year or 2 years. So that CD will give you a higher rate of interest without giving you the liquidity that a savings account would.
Sure. And that's one thing I want to briefly touch upon is the whole dark hole that is interest rates and the discussion around that. And I don't want to dive too much into it, but I think one thing you recognize now in the market at the time of this recording is that short-term interest rates are currently higher than longer-term interest rates. And
Absolutely.
I won't go into the technicalities of that, but that's what you're really seeing in the market right now is, a 6 month, 1 year, year and a half CD. You're going to be able to earn a little bit more interest on that right now than a longer term CD.
Absolutely. And the reason for that is because the interest rate market is volatile. And again, like you said, we don't have to get real deep into it, but I think everybody understands that rates are going up. It hasn't been that way in a long time, especially to the extent that we've had it recently. So I think, institutions are willing to pay more for the shorter term CDs for the 6 months, 12 months, 18 months, because they're willing to say, we'll commit to that period of time to pay you the higher interest rate. But we're not really ready to say 3, 4, or 5 years yet because we don't know what's coming down the road.
Yeah, exactly. And so that's one thing to keep in mind is that's obviously the current market environment. The market's changing daily.
Absolutely, all the time.
And so we need to keep an eye on that. And if you're going to open up a CD, ask your banker what the rates are. And they'll give you a sheet and they'll show you what different terms are and everything. And then you can decide what's right for you. If you're planning on buying a house 2 years down the line, maybe you want to use some of that CD for a down payment.
Absolutely.
So maybe you wait, maybe you do an 18-month CD so that those funds are available for when you're ready to purchase a house.
Yeah, and the other thing about CDs is they're great for people that want to earn a little bit more on their money, but they're maybe a little risk adverse. They're worried about the market, having their money in a volatile market. But they're FDIC insured, so up to $250,000 for that account, they know that their money is safe if they put it in that CD. So that's also it's very appealing.
The next topic I want to dive into is minor savings accounts. So sure. I have two young children, and I've opened up savings accounts for them. What are some tips you can give to those parents that are having their first child, or maybe have two or three children already? What tips can you give them to opening up a savings account for their kids?
Well, I think the minor savings account we can get into that, but first I kind of want to talk about. I think we all would agree it's important to teach our children how to save, mm-hmm. and I think that. This is just one vehicle that you can use for it, which is a minor savings account. A minor savings account is opened in the child's name with their social security number. However, there's a guardian or a custodian who is in charge of those funds. Typically, it's a mom or dad. It might be a grandparent or even an aunt or an uncle, but there has to be an adult on the account to help manage the account. The idea being that the money is owned by the kid, but they need some guidance on, how they should be using their money. So kind of what we've been talking about. So the guardian gets set up so you can deposit into the account. If you've got a 16-year-old that's got a job and they have direct deposit, that money can go into the minor savings. However, the only way that they can do a withdrawal is if the guardian signs that withdrawal slip. And it is a savings account, so you don't want to be doing a lot of withdrawals. So that's a conversation you want to have with your kid, especially if they're getting their paycheck deposited in there. I think they're all going to want some of that to go out and have fun and do those things, and that's great. But the guardian's there to help make sure they're not just, blowing through that money and not getting towards whatever their savings goal might be.
Yeah, and I think that's one thing as a community bank too. We really focus on that next generation and teaching them how to save. And as you may have noticed, we have our little piggy banks out here
wonderful
today.
Piggy banks. I know those are great. So that can be another vehicle for mm-hmm. savings as well. You talked about your young kids. I have young kids too. I think it's really important for them to have the visual portion of saving. And that's where the piggy banks are really handy. Quarters, nickels, dimes, but then you get the bills. My kids are old enough, they're doing chores, so they're getting an allowance every week. I was just negotiating with my son the other day about, he wants to buy this certain toy, and he's got this much money to put towards it. Will we pay the other part of it? And I said, let's see what's in your piggy bank. Let's figure it out. So having those conversations is really important, and it gives them a goal, and it gives them a reason to work and earn money, and they start understanding how that all kind of comes together.
Yeah, sounds like you got a tough negotiator on your hands.
He is. He's I don't know. Looking for a job? I don't know where it comes from. Well, he might be. So we're gonna have to check into that. But I think the tips for teaching kids to save, I looked at them. The first one is really discussing needs versus wants. Because with kids, it's all wants. They're not thinking about, is there food in the fridge? Is there gas in the tank? They're thinking about, what do I want next? What's the next big thing? Whether it's a video game or a toy or who knows? Who knows what they think? They change their mind every 2 seconds. So that's the big thing. But then letting them earn their own money, making sure that you're giving them a way to earn money so they're not always looking for you to just give it to them. And that will help them, teach them to save long term, because then you can start talking about savings goals. Now you're earning this money. Let's take a portion of it to go buy bubble gum or ice cream or whatever you want. But let's set some of it aside because you had that video game you wanted to buy and it costs X number of dollars. Then they start to get it. They start to see, okay, I'm earning money. Now I can buy some of these bigger things that I used to count on mom and dad to get for me. And now maybe mom and dad, we're kind of their creditor, if you will.
Yeah.
But if we provide them, they're understanding employment. I mean, that's really what employment's all about. So that's the big one.
I'm really glad you brought up needs versus wants. That's something we talked about in our previous financial literacy podcast.
Yeah, it goes for everybody, not just kids.
Yep. I think the comparison we did with Monica was, did we really need that extra donut?
Sure.
Did we really need to go out there and get that?
I certainly didn't need the extra donut.
But I think needs versus want is an important thing for all ages to understand. It's really important if you start to save to differentiate what do you really need compared to what do you really want. Do you need to go eat out 3 times a week, or could you maybe make it one special night a week and then eat in the rest of those meals and cook at home?
Yeah, and I when I teach the financial literacy classes out in the community, that's one of the things we talk about is did you need to stop for a coffee every morning? I mean, if you're going to the gas station, you're paying $1 for a coffee, it doesn't seem like that big a deal. But if you're going to another coffee place where it's $3, $4, $5, $6 a coffee, now did you really need that, or could you have made a pot at home, got a travel mug, and taken it with you? So those types of things I think are really important. Not just the needs versus wants, especially when it comes to kids, but also providing a place to save, like the piggy bank, like the minor savings account. So,
well, Tim, I really want to thank you for coming on today. I think we've passed on a lot of good knowledge, and just to circle back, we really talked about establishing that emergency fund to start out with. And then when you've really established that emergency fund and say you have more than what you really need for however long you determine that emergency fund is needed for, then maybe you put some more money into CD to earn a little more interest rates. And, down the line in the podcast, we're going to talk a little bit more about some other investment vehicles and whatnot. But really, savings accounts and CDs are a phenomenal start to saving, and it all starts back in the minor savings account. If you can start to save early, it goes a long way.
Well, and I think the other part of that is looking at, once you have that emergency fund, what are my short-term, medium-term, long-term goals? Do I want to buy a car? Do I want to buy a home? Do I just want to save up for a new refrigerator? What is it? And prioritize those goals so that what, not just that you're saving, but what you're saving for.
Yeah, I think that's really important that we press on. And that's one of the big goals of the podcast, is just to educate and hopefully, as always, with our listeners, they were able to take one thing away from this podcast and learn something, or at least able to ask that question when they're in the bank the next time.
Absolutely.
Because that's the biggest thing. Ask the question. Don't be afraid to ask the question, because all banks, not just ours, all community banks, we're here to help.
That's what we're here for. I mean, if I go to my mechanic and I've got something wrong with my car, I'm going to be asking, I don't know what's going on with it. It's making a weird noise. It's the same thing here. When you come in here, this is what we do. This is what we're good at. This is what we're experts at. Ask those questions, because it's not something that most people deal with every day.
Well, Tim, thanks again for coming on. We really appreciate it. Once again, thanks for listening to the BankCents podcast, the podcast that makes sense of all things banking. Until next time.
Is there something about banking that doesn't make sense to you? Submit your questions to us on Instagram Messenger or by email, bankcents@bankwithbos.com. Or if you're watching this on YouTube, comment below. We're happy to give you our 2 cents on a wide range of topics. Thank you for listening on Spotify, YouTube, or wherever you get your podcasts. And please leave us a 5-star rating and review so we can continue to bring you more educational content. Thank you for listening, and we hope you join us on the next episode of BankCents.